Disclaimer.
They call me AG, and I've got to say, there's a certain irony in explaining how China just nuked the global silver market on New Year's Day while everyone else is making resolutions they won't keep. But unlike your gym membership, this resolution from Beijing is actually going to change your financial reality whether you're ready or not. Pop quiz. What happens when the world's largest silver producer suddenly stops selling to the West on the exact same day that our futures exchanges run dangerously low on the actual metal they've been promising to deliver? We're about to find out, because January 1st, 2026 isn't just another New Year's Day. It's the day China flipped a switch that could expose one of the longest-running price manipulation schemes in modern financial history, and you're watching it unfold in real time, whether you own silver or not. Here's what's happening right now while you're reading this. At exactly midnight, Beijing time, China's new export licensing system went live, and it comes with a requirement that should make every investor's head turn. You need to demonstrate you can handle at least 80 tons of refined silver just to qualify for an export license. Think about that number for a moment. Most silver refiners and trading houses around the world can't touch that threshold, which means China just effectively cut off somewhere between 60% and 70% of the globe's refined silver supply with the stroke of a regulatory pen. But here's where it gets interesting, and I need you to pay close attention to these numbers because they reveal something our financial system has been hiding for decades. Right now, physical silver trading in Shanghai is commanding prices more than $20 per ounce above what you see quoted on our COMEX futures exchange in New York. Let me put that in perspective. If you wanted to buy actual deliverable silver in China today, you'd be paying around $91 per ounce, while paper contracts in New York are still trading at roughly $71. That's not a small discrepancy we can blame on shipping costs or import duties. That's a massive price gap, screaming that something is fundamentally broken in how we've been pricing silver in the Western world, and the gap is threatening to explode to $50 or more as our vaults continue hemorrhaging the physical metal that's supposed to back all those paper promises. Now, if you've been watching silver markets for any length of time, you might be thinking this sounds like another conspiracy theory about price suppression. But what if I told you we now have mathematical proof that the suppression was real all along, and it's about to unravel in spectacular fashion? Because the physical metal simply isn't there anymore. Let's talk about what's been happening inside the COMEX vaults, because this is where the paper market's dirty secret gets exposed in broad daylight. According to COMEX's own publicly available inventory data, the exchange held 346 million ounces of silver back in 2020. That's a substantial amount of metal backing the world's most important silver futures market, the benchmark that sets prices for industries from solar panels to electronics to photography. Fast forward to today, and those same vaults hold just 82 million ounces. Think about what that means for a second. We're talking about a 73% collapse in inventory over the span of just 5 years, and that's not even the most alarming part of this story. What should really grab our attention is what happened just last month in December. The COMEX experienced a vault drain so severe it claimed 60% of the exchange's remaining registered silver inventory in just 4 days. 4 days. Not 4 months or 4 weeks. The registered category represents silver that's actually available for delivery against futures contracts, and more than half of it vanished in less than a week of trading. Here's why that matters to you, even if you've never traded a silver futures contract in your life. Every industry that depends on silver for manufacturing, from your smartphone to the solar panels being installed on rooftops across America to the electrical contacts in every vehicle rolling off assembly lines, relies on COMEX pricing to plan their material costs and manage their supply chains. When that pricing mechanism is built on a foundation of paper promises backed by metal that does not actually exist in sufficient quantities, we're not just talking about a problem for commodity traders. We're talking about a systemic issue that could ripple through our entire economy. The exchange has been selling contracts that guarantee delivery of physical silver, but the math is starting to reveal an uncomfortable truth. They've been writing far more promises than they have metal to deliver, and they've gotten away with it for decades, because most traders simply settle in cash rather than demanding the actual silver. It's the financial equivalent of a bank that stays solvent only because most depositors never try to withdraw their money at the same time. But what happens when China's export restrictions force Western industrial buyers to actually demand delivery from our exchanges because they can no longer source silver from Asia? What happens when the traditional supply channels dry up and everyone holding those paper contracts realizes they might actually need the physical metal they thought they owned? That's the pressure building right now in the silver market, and the price gap between Shanghai and COMEX is just the visible symptom of a much deeper problem. To understand the real magnitude of what we're facing, we need to look at what silver should actually cost, based on fundamental supply and demand, completely divorced from the manipulated futures prices we've been conditioned to accept as normal. Think about this scenario for a moment. You're running a solar panel manufacturing facility, and your production line requires a steady supply of silver paste for the photovoltaic cells that convert sunlight into electricity. For years, you've been able to source that silver at prices determined by COMEX futures, and you've built your entire cost structure around those benchmark prices. Now imagine waking up to discover that the exchange you've relied on for price discovery is running critically low on deliverable metal while the Shanghai market, where actual physical silver changes hands, is trading at premiums that would destroy your profit margins if you had to pay those prices. Do you shut down your production line and disappoint customers who've already paid deposits? Do you scramble to secure silver at whatever price the physical market demands? Or do you hope the COMEX somehow finds more metal before your inventory runs out? That's the reality facing industrial silver users right now, and it's why the price gap mechanism we're witnessing reveals something far more significant than a temporary market dislocation. When Shanghai physical silver peaked at $91 while COMEX paper contracts traded at $71, that $20 spread was telling us the century-old suppression scheme could no longer hide the true value of deliverable metal. But here's what most market observers are missing when they focus solely on that Shanghai premium. The real gap emerges when you calculate what silver should cost based on the underlying fundamentals, particularly the massive deficit between annual production and annual consumption that's been building for years. According to data from the Silver Institute, global silver demand has exceeded mine supply by roughly 230 million ounces annually when you account for industrial consumption, investment demand, and jewelry fabrication. That deficit has to be filled from somewhere, and for years it came from above-ground inventories that governments and investors accumulated during previous decades when silver was far more abundant. The problem is, we've been draining those inventory stockpiles at an accelerating rate, while mine production has remained essentially flat or even declined slightly. Eventually, the math catches up. Eventually, the inventories run low enough that the paper price mechanism breaks down because there simply isn't enough physical metal to deliver against all the outstanding contracts. That's exactly what the collapsing COMEX inventories are showing us. We're watching the endgame of a pricing system that depended on abundant stockpiles to maintain the illusion that paper contracts and physical metal were interchangeable. As those stockpiles evaporate, the gap between paper prices and physical reality widens, and China's export restrictions just accelerated that process dramatically by cutting off a major source of supply that Western markets had been counting on. When you factor in the 230 million ounce annual deficit, the collapsing exchange inventories, and now the sudden loss of Chinese supply, the true price of silver based on available physical metal could easily sit $50 or more above the manipulated futures prices we're still seeing quoted on financial news channels. That's not speculation or hopeful thinking from silver enthusiasts. That's mathematical reality backed by publicly available supply and demand data, inventory figures that exchanges are required to report, and the widening price gaps we're observing between paper markets and physical markets across multiple global trading centers. The question isn't whether this gap will close. The question is whether COMEX prices rise to meet physical reality, or whether the entire paper market structure collapses under the weight of delivery demands it can't possibly fulfill. Either way, our understanding of what silver is worth is about to undergo a dramatic reset, and it's happening right now as China's export restrictions begin channeling global demand toward exchanges that may not have the metal to meet that demand. Now I know what you're thinking, because I hear it every time I talk about commodity market dysfunction. You're wondering if this is just another case of a trader getting excited about short-term price movements that won't matter in 6 months. So let me show you the math that makes this situation completely different from typical market volatility. Because the numbers don't lie, and they certainly don't care about our opinions. According to data compiled by the Silver Institute and cross-referenced with mining industry reports, global silver markets have been running a cumulative deficit of approximately 800 million ounces over the past 5 years from 2021 through 2025. Let that sink in for a moment. We're not talking about a single year where demand exceeded supply by a small margin. We're talking about nearly 1 billion ounces of silver that was consumed beyond what came out of the ground during that period. Have you noticed what happened to silver prices during those 5 years of massive deficits? They barely moved in any sustained direction, which should tell you immediately that something was interfering with normal price discovery. In a functioning market, when you consume 800 million more ounces than you produce, prices should skyrocket until demand destruction kicks in, or new supply comes online. Neither of those things happened, which means the paper market was successfully suppressing prices even as physical inventories were being drained at unprecedented rates. But here's where the supply side of this equation gets really interesting, and why this deficit can't be solved simply by higher prices incentivizing more production. According to the World Bureau of Metal Statistics and confirmed by major mining companies in their annual reports, global mine production of silver has actually been falling at a rate of roughly 0.9% annually. In a market with soaring demand and collapsing inventories, production is going backwards. Why would silver production decline when industrial demand is hitting record levels? The answer reveals a fundamental constraint that most investors don't understand about silver mining. Between 75% and 80% of all silver that comes out of the ground is not the result of companies specifically mining for silver. It comes as a byproduct of copper mining, zinc mining, and lead mining operations, where silver just happens to be present in the ore alongside the primary metal. Think about what that means for supply response. Even if silver prices doubled to $100 per ounce tomorrow, mining companies can't just flip a switch and produce more silver. They would need the underlying economics of copper and zinc mining to justify expanding those operations. Because you can't mine the silver without mining the base metals it's attached to. It's like trying to get more egg yolks without getting more egg whites. They come together whether you want them to or not. So we've got structurally declining, supply meeting exponentially growing demand, particularly from the solar industry, which has become the single largest consumer of silver globally. The math simply doesn't work in favor of the paper market, maintaining its price suppression scheme much longer, but that's still just the supply and demand fundamentals. What really proves we're witnessing a historic market break are the technical signals coming from multiple silver markets simultaneously. Let me introduce you to a concept that should terrify anyone still holding paper, silver contracts instead of physical metal: backwardation. In normal commodity markets, futures contracts for delivery months further in the future trade at higher prices than near-term contracts, reflecting storage costs and the time value of money. When that relationship inverts and near-term prices exceed future prices, it signals that physical material is in such high demand that traders are willing to pay premium prices for immediate delivery. Now here's what should make every market observer sit up and take notice. We're not just seeing backwardation in one silver market. We're seeing it simultaneously in Shanghai, London, and increasingly in COMEX futures as well. This is a triple backwardation crisis that I've never seen in my years following precious metals markets. And it's screaming that physical scarcity has reached critical levels across the global silver trading system. The Shanghai futures market has been trading roughly $3,000 per contract below the spot price for physical silver. Read that again, because it defies everything we think we know about how commodity markets should function. Futures contracts, which represent promises to deliver silver in the future, are worth less than the spot price for immediate delivery. That tells you the market has completely lost faith in the ability of paper contracts to convert into actual metal when delivery time arrives. Meanwhile, in London, the forward curve that typically slopes upward, reflecting normal market conditions, has inverted for the first time in decades, according to data from the London Bullion Market Association. And perhaps most tellingly, silver lease rates, the cost to borrow physical silver for short-term delivery, have spiked to annualized rates of 200% compared to the normal range of around 0.5%. Let me put that 200% lease rate in perspective for you. That means if you need physical silver today and want to borrow it with a promise to return it later, you're paying double the value of that silver annually, just for the privilege of having it in your possession now. That's not a lease rate. That's a desperation rate paid by industrial users who can't afford to wait for their supply chains to normalize because their production lines would shut down without the silver they need. These aren't abstract market indicators that only matter to commodity traders. These are concrete signals from the physical silver market telling us that immediate deliverable metal has become extraordinarily scarce, and the pricing mechanisms we've relied on for decades are breaking down under the pressure of that scarcity. But if you still think this might be temporary market stress that will resolve itself, let me show you what the insiders are doing with their own money, because actions speak louder than any chart or data point I could show you. Major solar panel manufacturers, which consume roughly 20% of global silver supply for the photovoltaic cells in their panels, have faced price increases of 180% over the past 3 years for the silver paste they use in production. In a normal market, manufacturers respond to dramatic cost increases by reducing consumption, finding substitutes, or raising prices to customers. But according to industry reports from solar manufacturers and confirmed by materials sourcing data, these companies have actually increased their silver purchases during this period of soaring prices. Why would a rational business increase consumption of a material that just became 180% more expensive? Because they're making a calculated bet that current prices, as painful as they are, represent the cheapest silver they'll be able to secure for the foreseeable future. They're hoarding physical metal while they still can, which tells you their procurement teams are seeing supply disruption signals that aren't fully reflected in public market prices yet. Then we have JPMorgan, which has been one of the most sophisticated players in precious metals markets for decades. According to publicly available ETF disclosure documents, JPMorgan withdrew 3 million ounces of silver from the SLV exchange-traded fund for the first time this decade. Think about the signal that sends. One of the world's premier financial institutions, with access to every silver market and trading venue globally, decided it would rather hold physical metal than shares in an ETF that's supposed to represent physical metal. What does JPMorgan know that prompted them to pull metal out of the most liquid silver ETF in the world? They're seeing the same inventory data we're seeing, the same backwardation signals, the same supply constraints from China's export restrictions. And they're voting with their actions by taking delivery of actual silver while it's still possible to get it. But perhaps the most telling insider action comes from China's State Administration of Foreign Exchange, known as SAFE, which manages the country's foreign reserves. According to reports that emerged from Chinese financial disclosures and were later confirmed by international analysts, SAFE secretly doubled its gold holdings over a recent period, while systematically reducing its exposure to dollar-denominated assets. Now you might be asking what gold has to do with silver, but here's the connection. China's Foreign Exchange Authority doesn't make casual decisions about reserve allocation. When they double down on physical precious metals while reducing paper currency exposure, they're making a strategic statement about the future reliability of Western financial markets and paper asset pricing mechanisms. If they've lost faith in the dollar pricing system for gold, it's a safe bet they've reached similar conclusions about silver, which is why the export restrictions aren't just about industrial policy. China is positioning itself to benefit from a repricing of physical precious metals relative to paper markets, and they're willing to cut off supply to Western markets to accelerate that repricing. The export licensing requirements that kicked in today aren't a temporary measure or a negotiating tactic. They're a structural shift in how silver flows around the world designed to keep the physical metal in Asia, where it is increasingly valued for its industrial applications, in solar energy electronics manufacturing, and as a monetary hedge against Western currency debasement. Every one of these insider actions points in the same direction. Sophisticated players with access to better information than retail investors are grabbing physical metal and getting out of paper markets while they still can. Solar manufacturers stockpiling silver despite price increases, JPMorgan pulling metal out of ETFs, China's Reserves Authority doubling gold holdings while cutting off silver exports. These aren't coincidences or unrelated events. These are coordinated responses to the same underlying reality that the supply and demand fundamentals are revealing. There isn't enough physical silver to meet global demand at current prices. The inventory buffers that masked that shortage for years are nearly depleted, and the paper market pricing mechanism is about to break when Western industrial users realize they can't source the metal they need from Asian suppliers anymore. The proof isn't in conspiracy theories or market manipulation accusations. The proof is in the math, showing 800 million ounces of cumulative deficits in the triple backwardation across global markets, in the 200% lease rates that prove physical silver is essentially unobtainable at published prices, and in the actions of insiders who are positioning for a dramatic repricing that hasn't fully materialized in paper markets yet, but is inevitable given the fundamental supply constraints we're facing. So now we arrive at the question that matters most to anyone watching this unfold. What is physical silver actually worth when you strip away the paper market manipulation and calculate its value based purely on supply, demand, and availability? Let's work through this calculation step by step, because I want you to understand exactly how we arrive at that $50 price gap I mentioned at the beginning, and why it's not speculative projection, but mathematical inevitability based on current market conditions. We start with Shanghai physical silver trading at $91 per ounce, while COMEX paper contracts sit at $71. That's our baseline $20 gap that's already visible in real-time market pricing. But that gap only reflects the premium Asian buyers are currently willing to pay for immediate delivery versus paper promises. It doesn't account for what happens when Western industrial users lose access to Chinese supply and have to compete for the remaining 30% to 40% of global refined silver that will still be available outside China as export restrictions. Here's where the calculation gets really interesting. According to supply chain analysis from major solar manufacturers, the substitution break-even point where they would switch from silver to alternative materials in photovoltaic cell production sits at approximately $134 per ounce. Below that price, silver remains the most cost-effective solution despite its price increases. Above that price, the economics flip and manufacturers start redesigning their production processes to use copper or other materials that don't perform quite as well, but become cheaper alternatives. That $134 substitution threshold tells us something crucial about how high silver prices can rise before demand destruction kicks in. Solar manufacturers, which represent the single largest and fastest growing source of silver demand globally, won't stop buying until silver crosses that threshold. They'll absorb price increases all the way to $134 because their entire business model depends on silver's unique properties for converting sunlight into electricity efficiently. So now let's think about the supply side of this equation. China's export licensing system that went live today cuts off roughly 60% to 70% of global refined silver supply from Western markets. That means industries in North America, Europe, and other non-Asian regions are now competing for 30% to 40% of previous supply levels, while their demand hasn't decreased at all. What happens to prices when demand remains constant but available supply drops by more than half? Basic economics tells us prices rise until either supply increases to meet demand or demand falls to meet available supply. But we already know from the mining data that supply can't increase because 75% to 80% of silver is a byproduct of base metal mining. And we know demand will not fall until prices exceed $134 and force solar manufacturers into substitution. This is where the true price of deliverable physical silver emerges from the math. If Shanghai is already at $91 with Chinese buyers having access to domestic supply, what price will clear the market when Western buyers, who previously relied on Chinese exports, now have to bid against each other for the limited supply still available outside Asia? The calculation suggests somewhere between $120 and $140 per ounce represents the equilibrium price where the reduced supply matches industrial demand that hasn't yet hit substitution thresholds. That puts the true physical silver price $50 to $70 above the current COMEX paper price of $71. The $50 gap isn't a prediction, it's the mathematical outcome of current supply constraints meeting inflexible industrial demand. But here's what should really concern anyone still treating this as an abstract market discussion that does not affect their daily life. We're not talking about a gradual price adjustment that unfolds over months or years. We're talking about a potential gap up that could happen overnight when COMEX faces its next major delivery crunch, and that crunch is coming sooner than most people realize. According to COMEX's publicly available open interest data, the March 2026 delivery month currently shows contracts representing more than 100 million ounces of silver. Remember, the exchange only has 82 million ounces of registered inventory available for delivery. That's a 20 million ounce shortfall if even a modest percentage of contract holders demand physical delivery instead of a cash settlement. Now, think back to what happened in December when we saw a single-day delivery demand of 36.65 million ounces that drained 60% of registered inventory in just 4 days. What happens if that pattern repeats in March when open interest is even higher and available inventory is even lower? COMEX faces a binary choice that will expose the paper market fraud in spectacular fashion. Option 1, the exchange allows prices to gap up overnight to whatever level is necessary to discourage physical delivery and encourage cash settlement instead. Based on our calculation of where physical silver actually trades when supply is constrained, that means a potential overnight move to $120 or higher to reflect the true cost of sourcing deliverable metal in a supply-constrained market. Option 2, COMEX declares force majeure and ends physical delivery altogether, admitting they can't fulfill the contracts they've been selling and exposing 150 years of price manipulation where paper promises were never fully backed by physical metal. That outcome would destroy confidence in commodity futures markets broadly and force a complete repricing of precious metals based solely on physical availability rather than paper contract trading. Neither option is good for anyone who believed COMEX prices represented true market values or anyone who holds paper silver contracts expecting they can convert to physical metal when needed. But one of those two outcomes is inevitable given the math we're looking at, with open interest exceeding available inventory by significant margins. Here's what makes the March delivery crunch even more critical: timing. We're standing at the beginning of January right now, which means we have roughly 60 days before the March contracts start demanding delivery. 60 days might sound like enough time for the market to adjust or for new supply to materialize, but let's look at what's actually possible in that time frame. Western vault inventories currently hold approximately 30 to 45 days of supply based on current industrial consumption rates, according to metals consulting firms that track these inventories. That's the buffer between normal operations and complete supply disruption for manufacturers who depend on steady silver deliveries to keep their production lines running. China's export licensing system started today, January 1st, which means the flow of Chinese silver to Western markets has already been drastically reduced or eliminated entirely for most buyers. Industrial users will start feeling that supply pinch within weeks as their existing inventories run low, and they discover they can't simply order more from their traditional Asian suppliers. Meanwhile, Global silver demand continues running at 1.24 billion ounces annually, while production can only deliver 1.01 billion ounces, according to the most recent Silver Institute supply and demand reports. That's a 230 million ounce annual deficit that has to come from somewhere, and the somewhere it's been coming from, above ground inventories and Chinese exports, just became much less accessible or completely cut off. So in the next 60 days before the March COMEX delivery crunch, we're going to watch Western industrial users burn through their remaining inventory buffers while discovering they can't replenish from traditional supply sources. We're going to see the paper market continue trading at prices that don't reflect physical reality. And we're going to approach a moment where the gap between paper promises and physical availability becomes so obvious that even casual observers will recognize the system is broken. What should you do with this information? That depends on your situation, but let me give you the perspective I wish someone had given me before previous market dislocations I have witnessed. If you're an industrial user who depends on silver for manufacturing, you're already feeling the supply pressure and you've probably been building inventory while you still can. The question you need to answer is whether you've secured enough physical metal to carry you through a potential multi-month period where spot market purchases become prohibitively expensive or simply unavailable at any price. If you're an investor who owns paper silver contracts or silver ETFs, you need to understand the difference between owning claims on silver and owning actual physical metal. When supply constraints hit critical levels and delivery demands exceed available inventory, your paper claims might settle in cash at prices that don't reflect what physical silver is actually trading for in spot markets. JPMorgan already figured this out, which is why they pulled metal out of SLV. The question is whether you'll figure it out before the March crunch. And if you're someone who doesn't own silver at all and thinks this doesn't affect you, remember that silver is embedded in the solar panels being installed across our power grid in the electronics you use every day in medical equipment, in your vehicle's electrical systems, and in countless other applications you don't even think about. When silver prices gap up to reflect physical scarcity, those cost increases will ripple through supply chains and eventually show up in the prices you pay for goods and services across the economy. The $50 price gap we've been calculating isn't the ceiling for where silver could go. It's the floor representing the minimum repricing necessary to balance supply and demand once China's export restrictions force Western buyers to compete for limited available inventory. If industrial users panic and start hoarding, if investment demand accelerates as people recognize the paper market fraud, or if mining supply falls further due to base metal price weakness, that gap could easily expand beyond $50. But here's what I want you to take away from this entire analysis, because the specific price targets matter less than understanding the underlying dynamic that's playing out. For decades, the silver market operated under an illusion that paper contracts and physical metal were interchangeable, that exchanges had enough inventory to satisfy delivery demands, and that prices were set by supply and demand fundamentals rather than by the trading of derivatives that were not fully backed by real metal. China's export restrictions, combined with collapsing COMEX inventories and persistent supply deficits, are forcing that illusion to confront reality. The 60-day window we're in right now is the calm before the storm, the period where the old pricing system is still functioning, even though the fundamentals supporting it have already collapsed. By February or March 2026, when industrial users exhaust their inventory buffers and COMEX faces delivery demands it can't fulfill, the paper market's lie unravels completely. At that point, the $50 price gap we've calculated becomes the new normal rather than a shocking divergence from expectations, and anyone who understood what was coming will have already positioned themselves for that reality. You're watching one of the most significant commodity market dislocations in modern history unfold in real time. And the best part is, you don't have to take my word for it. The data is public, the math is straightforward, and the timeline is visible. China flipped the switch today. The countdown to the paper market's reckoning has already begun.